All right, couple ground rules. So when we get going, I'm going to obviously call on folks in the audience. When I call on you, if you can please keep your hand up. We're going to have folks with microphones, so they're going to need to be able to find you. And if you'll please wait until the microphone gets to you before you start asking the question, because it's not just for folks here in the room, but obviously we have people on the webcast, and we want to make sure that they get a chance to hear the question. So with that said, we'll open it up. Bill was the first one to raise his hand. So again, once I call his name, if the rest of the people can put their hands down, it'll make it a whole lot easier for them to figure out who is being called on.
Thank you. I think we'll zero in on, Kathy, your comment about M&A and holding back on share repurchase, because obviously we were thinking of size deals of Topo Chico and others where they shouldn't be mutually exclusive. So if you or James want to give us a little more color about what you have in mind, when that's going to happen, anything else would be great.
So I was clear that it will continue to be both on M&A that we will be looking to do. But so let me step back and say we have a cash allocation strategy, right? And you all know better than anybody that we have been doing share repurchase through debt, right? And our gross debt numbers are high. So we need to be careful on how, as we move forward. And since none of us know at this point about what tax reform is going to look like or what's going to happen, we need to be more cautious. And so part of that caution is going to be, going to give us opportunity to, as we need to expand and accelerate our growth, because top line growth is what we absolutely need, and that's the driver for everything, as James said this morning. We give us opportunities to be able to invest in more bolt-on M&A if we need it, to deliver our numbers and to grow our business and, for the next 130 years. So it's just simple mathematics.
Mark.
Thank you, too. Really great presentation. James, two-part question. You've heard the phrase culture eats strategy. So on the strategy side of things, what gives you the confidence in these big numbers for sparkling category growth and juice dairy growth? Because if those numbers don't play out, then your strategy's at risk. And then on the culture side of things, we've got a number of veterans here in the company who are demonstrating habit change. So could you speak a little bit about this culture that has been criticized, how you think you're having some success leading habit change so that culture can prevail over this strategy risk?
Prevail with the strategy, hopefully. I think on the growth of sparkling and the juice and the plant and the dairy, the growth is largely there. The sparkling category, notwithstanding that people want to keep saying that sparkling is not growing, the factual reality remains the same. Revenue of the sparkling category is growing in that 3% sort of range. So it's not a radically different number than what's been happening recently. Yes, any RTD category softened probably coming into the end of last year and the beginning of this year. But you can see in the Nielsen it's starting to tick back up. So sparkling category is in growth globally in revenue terms, and so is juice, dairy, and plant. What's required for this strategy to win is not some massive step change in the growth rate of the industry. There's a little bit more as the emerging markets come back, as Kathy had in her deck, but it's not a radical change. And it's not like it's heading down, it's got to head up. It's heading up, and we just expect to see it go a little faster. And there's so much innovation to be brought to it that we're very confident that those numbers are going to continue to hold true and be robust. And then in terms of the culture, I think the simple fact remains that while some of the old dogs here are managing to learn new tricks, including myself, the most important thing is that the organization, we won't say which ones are the old ones. The most important thing is that the organization feels unleashed, because the reality is that those successes are going to be generated by the people in the field, supported by the people in the head office. All we can do is encourage them and set a broad corridors of direction into the future. They're the ones that need to feel empowered. And I think you can absolutely feel that. You go around this campus, you go to any of the other offices, you can feel the change. They feel unleashed. They feel empowered to go and chase things. Is everyone with everything? No, and nor would you ever expect it to be. But I think you see an energy and a momentum.
Ali. Hand up. Thanks.
Thanks, guys. So I want to ask a question about margins in particular. Probably a surprise that I'm asking that question. But if you think about structurally, you're already going to 33%. That's structurally already there. You're then doing $3.8 billion you've been doing, to be fair, so some of it is complete. $3.8 billion of gross cost savings, call it. That's 14 points, something like that, from a top-line perspective, post-refranchising. You're then talking about further productivity, perhaps with lean. You're talking about scale benefits. You're talking about portfolio choices. You're going from 33 to 35, right? That's what you're saying. So are you saying you're going to have to reinvest all of this back in? And if you are, how does that jive at all with what you just said, James, from a top line, that we're not expecting much change in top line? We're not expecting, a heroic effort, I guess, from a top line perspective. So I don't get that. And in particular, I asked that question in terms of, we've heard a lot about growth today. I don't think anybody said the words return on investment or return, at least so far on stage. So really kind of pushing to try to understand a little bit better, please.
So the 33% that you're referring to is what we showed at CAGNY, I believe, and that is so given the currency impact, that starts at 32% really, because currency took about a point, to about 100 basis points. So yes, we're going to 32 to 35 plus. The plus is very important, by the way. Don't discount my plus. And I've got line of sight to what I gave you, 35 plus at this point. And I don't think any of us want to overcommit to anything, but we believe that we can get there. Yes, we have delivered about a little over $2 billion of the original $3 billion program, and then we have the other program that started this year. And yes, we are reinvesting. And yes, not just in marketing, we're investing in innovation, we're investing in a lot of the things that you saw today, and we're investing in digitization and our people, right? So we are investing in the things that we are doing, we believe make us a stronger company going forward. And so we committed to the 35 plus, and we will see where we go, but we committed to, by 2020, the 35 plus.
And maybe let me just add a couple of thoughts. I think over the last year or so, especially given all the induced complexity in the numbers of refranchising, we kind of got lost in the maze of tracking all the moving pieces of productivity, reinvestment, dropping to the bottom line, inflation, category mix, channel mix, geography, and currency, and it's just become very difficult to follow the breadcrumbs. So rather than trying to keep passing those down and then everyone making different assumptions about, well, okay, what are you assuming on, well, if productivity is on one side, is everything else constant margin or not? It's like, okay, let's put a margin target out there so everyone has clarity on the sum of all the breadcrumbs. And that's kind of what we've done. Judy.
Thank you. So obviously, I think Coke is very focused on putting a growth mindset into the organization. So we heard a lot about that today. I'm just wondering, just realistically, how does sort of change in the mindset actually translate into the performance? Because year to date, still category performance has been still a little bit lackluster. Clearly, given the category mix issues, you need to accelerate that growth. So realistically, how quickly can we see that? In 2018, can we see that mid-single-digit growth emerging from a top-line perspective?
Yeah, obviously we're not planning to give guidance on 2018, but let me offer a few thoughts. There's no question that, as I commented earlier, the category slowed at the back end. NERTD globally slowed at the back end of last year through Nielsen, coming into the first half, and you can start to see it come back out now. And it was in the 2.5s range rather than the 4. So you can start to see that come back up. So I think there's a part of it that's that. and we expect and we see the category rebuilding, so that's partly going to lift the boats. The other thing, and within the context of that, we're still gaining share. Now, we have made our own choices in the short term on where we want to focus in stills, and particularly in China, for example. We said, okay, look, we want to deprioritize some of this very low margin bulk water. It took at least 3 points off the growth rate in China just in the third quarter. So we are, as we are more driving people to be choiceful, and in the words of Francisco's words, kill off the zombies, the things that aren't going anywhere, that aren't making any money, to be a bit more rigorous, we're starting to shed some volume at the edges, which is partly pressuring the other categories. But that's a short-term effect.
Kevin.
Great, thanks. So a question on the U.S. business, probably for James, Francisco, Jim, maybe for you as well. Just with the benefit of hindsight, maybe some of the learnings for some of these smaller competing brands that have had some success. So like LaCroix and Sparkling, Body Armor and sports drinks, Bai's had a lot of success. So a lot of the strategies you guys went through makes a lot of sense. And Coke seemingly was very well positioned to capitalize on these trends and obviously does a ton of work around the consumer, but yet you've had these smaller sort of niche brands that don't have anywhere near the scale of the Coca-Cola Company, and they've had a good amount of success. So with the benefit of hindsight now, looking at some of these brands, how comfortable, James, do you feel with how nimble the company is at this point, the processes that are in place to capitalize on these trends, et cetera? Thank you.
Sure. I mean, I think, we're trying to become more nimble. As commented somewhere in one of the questions, as a Brit, it's kind of impossible to be happy or be content. So then, you can never be nimble enough in a way. So no, we weren't nimble enough. Now, having said that, it's not our expectation that we will capture every available opportunity and be the first to get them. I think that's an unrealistic expectation. And our ability to grow 4 to 6% doesn't require us to do so. We need to consistently gain share in a growing industry, and that's what will take us to the right level of top-line growth. Competitors, new and existing, will find opportunities. They'll have ideas that are resonating with consumers and customers. What we need to do is pay as much attention as possible to what's happening in the real world, and to be quick to act, and quicker to act into the future. But we will, the idea that there won't be other new ideas and new competitors emerging, I think, would be unrealistic. We've got to learn, and we've got to stick to our game plan of building brands, building master brands, building brands that have edge, creating leadership positions. And if something new happens, we need to learn quickly from it and move on. But it's a very competitive market, and there are a lot of entrants, and I think there always will be.
Laurent, Laurent.
Thank you. James, I mean, you said this, the beauty of the category is highly diversified, and you mentioned that almost, 50% of the sales of the consumption is coming from eating or drinking out. So could you please, tell us a bit more, give us more color about what you would be doing in the on-premise or food service category, freestyle, and should we expect, because it's a high number, 50%, the same level of growth in top line or profitability in that segment of the business than if you compare these to retail?
Yeah, let me make a few global comments, and if you want to talk about food service in the US. Look, the first big data point is eating out is growing faster than eating in globally, and it has been for a long period of time. So I think the chances are that bit of the pie will be faster growing than the rest of it. Yes, okay, you've got to net off that the drinking at home will be supported by people coming into commercial beverages from non-commercial beverages, but I think the chances are that will continue to be vibrant because the global trend is towards eating out in all its different shapes and forms. Now, I'll let Jim talk about freestyle and food service in the US, which is the kind of the fountain end, the more organized trade end of of the spectrum. But around the world, globally, this is a growing trend. Now, in some places, most places, it's all about smaller packaging. It's all about getting the distribution. It's one of the core strengths of the global bottling system, a bit like the mom and pop stores, is getting to these smaller eating and drinking outlets. Now, even those, case in point, China, there's an explosive use of e-commerce. Using the aggregator platforms, people order through an aggregator, direct it to a local mom and pop eating and drinking, and they deliver. So even there, we're having to innovate, getting on the aggregator platforms, being part of the food and beverage combo, making sure we have a package that can be shipped, so maybe not a returnable glass bottle, but something that can be shipped to the home. So we think that's going to be a vibrant part of the future.
Yeah, the only thing I was going to add, am I on?
Yeah.
Was, the food service business is a huge advantage for us in the U.S. It's the heritage of the company that really was never franchised in the U.S. So it's been a vertically integrated business for the beginning of the company. And it plays a unique role for us in a couple of ways. One, it's a great brand building opportunity in terms of brand sampling. It's also one of our biggest advantages in the U.S. is our connection with food with our brands, especially brand Coke. And you've seen a lot of that advertising, I'm assuming, recently about Coke and meals, which plays itself out in restaurants. But in the freestyle question, that's continuing to be a big strategy for us to implement freestyle. It's been very successful, and food service will continue to be a big strategic focus for us.
Lauren. You're in the middle, you're not going to get a...
I think they can see you, but I think you're okay.
Great, thank you. I was hoping that some collection of you could talk a little bit about the process, the relationship between corporate and in the markets, specifically with the bottlers, as you're thinking about lift and shift or timeline to develop new categories. So I thought it was interesting in Europe, it's like, we got to get the core right first, and it's post-2020 before lift and shift matters. In Latin America, still lots of growth in CSDs, but a decision to go early with a Powerade, right, to start expanding the other categories. So just that process, and especially now with the bottling network set, how that idea and information flows goes back and forth, and who's making the decisions about what to do and when.
So yeah, I'm happy to start. So and maybe I gave the wrong impression. We're actually doing all that stuff now. What I was trying to explain is that in terms of materially impacting the top line growth, it'll take a couple of years because it takes time. I mean, you put them in. The minute you decide to put something in, it's usually, in the case of others, actually, it was really quick. I mean, it took us 6 months, which is pretty unusual for us. But even then, we launched at the beginning of the year, and you think, it takes time to get it out and to begin to build some critical mass. So if you think about it that way, then you say, okay, by the time you get to 2020, you have enough market share, value share, to be able to build from there. And that's what I was trying to explain. But we're going like crazy, putting different things in different places.
I think a lot of it is, I think a lot of it is the focus that we want a system to have, the system being the bottlers and ourselves, all our associates. So for us in Latin America, our focus, our number one priority is around renewing category growth. We have the tax challenges around. We also see a movement from consumers into that space, and it's very profitable. So we've all agreed that this is an area of opportunity for us. So we're working very fast to reduce sugar content in our products, but at the same time, we're driving smaller packages, better margins, and we're being very focused about improving how we execute at the point of sale. So the process of deciding is we agree on what the big opportunities are. We think there are 3 big ones, so this is the first one. The second one is expand profitably in the non-sparkling categories, and within that, I mentioned earlier, juices, value-added dairy, and plant-based, where we see a lot of room to grow, and in hydration. And again, on the value-added part of hydration, how do we make money in it? There's a lot more opportunities. We think we need to be focused. I think our bottlers agree, because then you can direct your capital to where it has the biggest impact. So, but it's constant conversation, constant discussion around the opportunities and how to go capture them. Another piece is, are we bringing in the capabilities we need? Are we leveraging the ones we have? So this is constant conversation. Our business units are tasked with identifying those opportunities, getting together with our bottlers, and then deciding what is best inside that framework that we've established where we want them. You know, what Francisco talked about, explorer, challenger, leader space. So that's how we do it.
One example, take the R&D area. What's changing? The R&D in Shanghai reports into me. The 5 business unit presidents that report into me have a metric to move ideas faster and are being held accountable to not duplicate and not waste time. I'll give you an example, the RCG, the reformulation work that's been done in Asia has, I'd say, sped up 6-fold in the last 12 months. We've appointed the head of R&D was in Mexico, and she took with her all the stuff that Alfredo and his team were doing in Mexico and implemented it within 6 to 8 weeks.
Amit.
Thank you. 2 quick ones for Kathy and then one for James and Francisco as well. Sorry. Kathy, you talked about SAP re-implementation. Can you talk about the scope of that and timing of that? And then you provided a category mix negative on the top line. Is there a way to think about that on the OI margin line as well, if there is a mix impact to think about? And then for James and Francisco, I think what Francisco laid out is a pretty compelling case for, look, let's do things differently, and that has big impact on our future growth. How much conviction you have of continuing to give him support for those initiatives if it takes 4 years, 5 years, in some cases, to pan out? Thanks.
Okay. So first, the SAP re-implementation, that it's just starting. We received board approval this past October. It will, the basic finance system will be in a year, right? So we will be able to turn that on in 2019. And then we start moving to other bolt-on things, our marketing expense management system, the logistics system, manufacturing system, and they start after we get the basic financial system in. So all total, it's probably 24 months to 36 months all total, but different things come in different times, and you start getting benefits faster because different things come on at different times. So we start get benefits from this system in the first 6 months, frankly. So as far as the category, because that 1% we took off because we are so skewed to sparkling, and sparkling is growing at 3 to 4%. So we took the point off to recognize that in all fairness. And I would say, again, sparkling will continue to grow as we, and the margins on sparkling can grow because as we do things like renewing category growth initiatives, and so reformulating and changing our recipes and things, and working with our supply chain, we still find ways to expand the margins in sparkling. So we will manage that, right? And that's what the point we wanted to make. We'll manage the margin impact so that we get to that 35% plus margin.
Yeah, perhaps, is this on? Yeah. The only thing I would add to what Kathy said is obviously we have mapped out the different category country combinations that we have. When we see that, at least for the markets that do the vast majority of our business, we know that we have leadership positions where we are leaving money in the table. We are not capturing all the growth. We are not going as fast as we can to collect all that value. We have been having a conversation with the BUs that are ultimately empowered on what are the things that we can do to capture that part of the equation. How can we ensure that we really are looking for growth in revenues and transactions rather than volume, particularly in those leadership positions? Then we have checked the amount of experiments that we have, and we have mapped out how many experiments we have. And the truth is, we need to multiply significantly the amount of experiments that we have. When you see those, it is a good number, but we should triple or quadruple that, because not all of them are going to work, and that is what will be the seed for our future. Actually, we're not that bad in transforming, in getting exponential growth out of those experiments, probably because we're big, we have a good execution, but that is not a bad point. Now, we are not good in killing the zombies. So we have an awful lot of things that 3 years, 4 years after they were launched, they are not getting exponential growth, and they are only dragging attention, taking space in the gondola, making our lines inefficient. So we need to get better at that. More experiments, killing them faster. And in the middle area is where I think we have probably one of the largest opportunities. The vicious circle there is it does take a longer period of time to challenge and become a leader. So the trap is that normally you lose hope by September and you start cutting DME, right? And the bottler already knows that. So when you ask them, please go and execute, we're really serious about this, it's like, yeah, let's wait till September. That requires a different way of thinking. And we have the batting average for each of these places. We do know that over 60% of our growth in the next 2-3 years is going to come from just getting slightly better in our leadership positions. If we get significantly better, that would be, nice money on top and above. We are considering that we will get mildly better in the middle area, and that we will put more experiments out there, but not in a massive way at the beginning. When you project that 5 years, 10 years, then the growth changes, because you will get some of the experiments to become leaders in that time frame, and you will have the challengers becoming leaders. At that point, the growth comes in a very different way.
Carlos.
Thank you. I'm curious, how do you see the bottlers accelerating their digital platforms for better shopper and point of sale insights? And how do you inject yourself into the process of getting those best practices that some bottlers have transferred to other bottlers?
Firstly, I think we're making some good progress, but the world is going to be different in 5 years. So I think it's going to be a question of